Hello and good afternoon, everyone. We're glad to welcome you onto this webinar this afternoon. It's great to see so many attending, and we're looking forward to presenting part 2 of the Enterprise Value two-part series. I'm joined on the panel again today by Joe Brewer, consulting partner here at Oldfield. There's a lot of content in today's session, so be free to take notes as you go. There will also be a recording available afterwards if you don't manage to get all of it. And there'll also be a Q&A session at the end of the session today. So be free to post your questions in the Q&A box as you go along. And we'll pick these up at the end. And as always, for any technical issues, feel free to contact us through the chat function. So just to quickly recap on part 1, in our first event of this series, we explained how business value works. Normally calculated based on EBITDA times a multiple to arrive at enterprise value. And this is then adjusted for cash and debt to arrive at the overall company's share value. We shared exclusive information with you that you can't find on Google, showing you how size impacts business value. We talked about what a typical acquirer looks like and looks for, and finished off with some real life case studies from recent deals in the packaging industry. A key question coming out of part 1 was what specific factors about your business can either increase or, on the other hand, suppress enterprise value. Now, clearly, if you know what these are, you can do something about them, you can influence them, and that's what this session in part 2 is all about. So before we get into the meat of the presentation, Joe, did you have any initial thoughts on this very important subject?
Thanks, Jerry, and hello and welcome to all joining this webinar this afternoon. Good to see so many attendees. Yeah, my main thoughts on increasing business value and really recapping on what we covered in part 1 of the series was really, number 1 is really business has to be focused on profitability. So profit is just so important when it comes to business value. Business value, after all, is based on that, really, isn't it? So we'd urge everyone to think about return on investment in every decision and to maximize profit. You know, will that decision actually yield more profit in my business? Number 2 is really adding value versus destroying value. So again, we'd encourage everyone to build into your strategy or into your 3-year projection, you know, things that are going to add value to your company, not destroy value. So think about that in every decision you make. For example, if you were to invest heavily in equipment or stock or some sort of asset, that might affect the value. So bear that in mind. And then thirdly, you need to be working on this now. So important to look ahead, plan ahead when we're talking about selling our businesses. So not in 3 years' time, but start working on it now. Build a good track record of net profit for 3 years running, and then make sure your record keeping is impeccable, efficient systems in place now. Just trying to sort them out just before a sale just won't wash with the buyer. Do you think, Jerry?
Thanks, Joe. Some really interesting insights there that I think we should definitely carry forward. So with that, our agenda for today is as follows. Point 1, factors that affect your business multiple, what these are and what we can do about them. Point 2, how and when to structure for sale, making sure you've got that the structure right ahead of time. Thirdly, some case studies, some real life situations that we've come across, and I think this will really help to bring some of the things we're talking about, really bring them to life. And then wrapping up with some key takeaways and a Q&A session at the end. So firstly, what factors affect the multiple? Well, this really is the £1 million question. And of course, in practice, there's a lot of different factors that can affect the multiple, such as owner dependence, business size and growth rate, IP and own brands, dependence on customers and suppliers. We've actually identified at least 15, but we haven't obviously got time to go into them all today. So we thought we'd just focus on 3 that we felt were particularly important. And while we're going through these, I think there's 3 things that we'd like you to think about. Firstly, number 1, what does this look like in my business? For me, in my business. Number 2, how would a buyer look at that? How are they going to view that in respect of my business, and how is it going to influence their view of value? And thirdly, how do I improve it? So starting with key person dependence. And this really is a key reason why some business sales either don't achieve the price that they otherwise deserve, or in some cases fail altogether. And it continues to be the case that too many small and medium-sized businesses are dependent on the owners who originally were the entrepreneurial flair, the genius behind the original idea, and it all kind of hinges on them. And it's something that many of us have heard before, but it does remain a challenge. And at the point when you come to sell your business, to some degree at that point, you kind of lost interest in it and you want to get out of it as soon as you can. And then unsurprisingly, the buyer isn't too keen for you to go. And this is not just about how effective a delegator you are. It's whether you've built a business that can run successfully without you, including having experienced middle management in place. And what that really means is that you've successfully embedded the secret of your success into the processes and culture of your organization. Now, that's something that's easy to say. It's not easy to do, and it does require discipline and structure. And even once the owners free themselves up, it can still end up coming down to 1 or 2 key employees in the organization who can lose interest once they find out that there's a sale on the horizon, maybe. And we've certainly seen that happen in practice. One key way to try and prevent that is an employee share plan or a share option scheme for key employees. The idea being that incentivizes them to stay and help you build the business, grow it to an exit. And it's particularly important how this is structured so it gives genuine long-term incentive and also stacks up against the tax rules and the case law. We have seen a number of schemes which purport to offer short-term tax-efficient advantages and simply just don't stack up against the case law, and would be very difficult to defend if HMRC were to ever probe into it. So just needs care around how that's structured. So Joe, I think you were going to talk about protection of IP and own brands.
Good, thank you, Jerry, and thanks for that insight. So this is about registering IP and brand names. What we would suggest is that you list out all your brands and then register them as registered trademarks. So products that are yours or unique to you, you should be registered as well. So not just the names, but the actual products. So where products are concerned, go for registered designs. If you designed it, obviously, and go for a patent if you can, as that also has tax advantages in registering products as a patent. So there's a couple of reasons why you'd want to do this. One is protection. It obviously stops someone else copying your name, copying your product, and thus gives peace of mind to a buyer. You think of a buyer coming in and actually wanting to purchase your business. They want peace of mind that those brand names are protected. And then secondly, a company with a number of registered trademarks, for example, will be by definition more valuable as it's got a stronger USP and a competitive advantage. So register your IP and brands, and almost undoubtedly a higher multiple will actually apply to your business value. On customer dependence, this is really about the reliance or dependence you might have maybe on one or a few of your customers. So it's quite common in a business, as we know, for 20% of your customers to provide 80% of your sales. That's the 80-20 rule that we'd be familiar with. But what we're talking about here is if just one or two customers provide a high percentage of your turnover, then that's really a factor that increases the risk for the buyer, and that will reduce your multiple and consequently harm your business value. So, for example, in particular, if one customer provides, say, 25% of your turnover, and losing that customer would wipe out your net profit, then a buyer is going to hesitate, to say the least, and a valuer will take that into account when he's valuing the business. In the risk, you might say the risk matrix, he'll take that into account and reduce your business value. So I think the takeaway from that is just look at your customer, look at your customers, make sure that you're not too dependent on any one particular customer. Thanks, Jerry. Back to you.
So just moving on from there, I think some really useful insights there, and would certainly encourage you to take those away and think about them. On the subject of structuring for sale, the key question here is, have you got separate elements to your business? Have you got even separate business models operating within your business? And if so, should you be structuring those so that they're actually in separate companies, so that they're ready for sale? And I think a key point here that's worth emphasizing is that buyers don't like buying part of a business. They want to buy kind of all or nothing, which means that, you know, in a scenario where your business is actually structured incorrectly in view of sale, it could actually harm your business value, and or alternatively, if it's not structured correctly for tax, it could mean that you lose more of the proceeds in tax than you should do. Also, just a bit of a general health warning here, which is that sometimes, if you like, overdoing the year-end tax planning can actually be a negative thing. By being too aggressive with your stock write-downs and bad debt provisions and so on, it can actually harm your business value by actually suppressing your EBITDA. So it's important to have a balance when you're looking at that. Think about the long term as well as the short term, in other words. So your business structure does need to be right for sale, and it needs to be right for sale in plenty of time. Some factors that can impact whether or not it's right for sale include whether you're likely to, how you're likely to structure a business sale. So is it likely to be in a single transaction, or are you going to be selling separate parts of it at separate times? And also, what are you planning to do with the sale proceeds? And I appreciate that if a business sale feels a long way away, what you're going to do after a business sale feels even further away. But it is important to think about, are you going to reinvest that money? Are you wanting to extract it for personal reasons? And depending on what outcome you're looking for, it is actually possible to structure a business sale so that you pay no tax at all on the proceeds. So the point is that you need to think about this early on. HMRC are wary of attempts to restructure for a tax advantage shortly before sale. And also certain reliefs have qualifying periods which are kind of non-negotiable. You simply have to meet those conditions in order to get that relief. And in particular on that point, we have seen a number of businesses in recent times where sometimes none of the shareholders actually qualify for entrepreneurs relief or business asset disposal relief, as it's now called. And they didn't even realize, they didn't even know that they didn't qualify, just down to a technicality, and which could literally cost hundreds of thousands of pounds in tax when they come to sale. So really important to make sure that that's thought about in enough time. Main takeaway here obviously is careful structure planning well in advance, but at the latest 2 years prior to a sale is just absolutely essential in maximizing return that you then get when you come to sell the business. So moving on from there, I think, Joe, you were going to take us through some real life case studies to bring this all to life.
Thanks, Jerry. That's useful insights there. And yes, we wanted to run through 3 case studies, really. One, the first one being a sample buyer. And this is a buyer that we've come across that's shown interest in some of our clients. And whilst we can't disclose the name, they are obviously actively looking to acquire businesses up and down the country. So it's quite interesting, but just really to focus in not who they are, but focus on what a buyer often looks like. So this particular company is growing rapidly, and their growth comes from, a third of it comes from organic growth. That's obviously increasing their own sales, and 2/3 comes from acquisition. So they're really serious buyers, and they've got a budget of 330 million per annum for acquisitions. That's a huge amount of money, 330 million pounds every year they're spending on buying businesses in the UK alone. And interestingly, they look at 150 opportunities every year. So that's quite a big number. And they actually buy, out of the 150, they actually buy 15. So that, you know, we need to think about that as well. What would, if we were going to sell, what would actually make us be in that 10% that they actually go ahead with, if you follow? So that's quite important. And they tell us that the main thing they look for in buying a business is scalability. You know, has the business reached a glass ceiling? Has it actually, you know, what's the size of the market? And also, is it scalable? Can the business be scaled up quickly? That's what they're looking for all the time. And also, from experience, they have their own modeling and valuation tools that they use. So they've already got an idea of the value and what they want to pay before they even turn up. And then finally, you certainly won't pull the wool over their eyes. You know, they're more experienced at this than you are. They're more experienced than any of us because of the number of opportunities they look at every year. Then I wanted to talk about a real life case study that we had where it was an unsuccessful business sale. So this one didn't go ahead, but it's got some really good learns in it, I think, that we can learn from you might say negative experience. So this particular buyer came along to look at a business with a view to buying it, and they were quite serious about it. But they were mainly concerned about the loss of human capital. So the 2 owners wanted to leave the business as quickly as possible. And that was a huge negative when it came to the buyers. Also, the records were not great. So by this, we don't mean the actual accounts, whether the accounts were accurate or not. We're talking about the sort of background records. For example, their hire fleet had a list of assets. It didn't match up with what was on the balance sheet. You know, the records were sketchy and hastily put together, ready for this presentation to the buyer. And it just didn't stack up. So I think the takeaway from that particularly is that your records must be impeccable. You know, your asset list must tie up with the accounts. They must be proven. You must have good depreciation schedules and so on. You must be able to show what you are selling, and it must be real. Also, the buyers said that buying only part of the business was not very attractive to them. So the particular business that was up for sale wanted to retain part of it for their own use, you know, continue with part, and the buyers said that wasn't very attractive, which you can understand. They're also surprisingly interested in the computer programs and the systems of business. They might say, well, why should they be? Why? Surely a buyer would want to integrate this business into their existing systems. But no, they were really interested in what systems were used, what software, what computer programs were used, and so on. Also, they were very interested in the org chart. They spent quite a long time looking at the staff, you know, their positions and how long those staff had been in those positions. That was very important to them. The length of time the staff had been with the company was really, really important. Obviously for continuity and reliability. So I think the takeaway really from that whole thing was the intangible things, people, IP, systems, and the owners are actually big in the buyer's mind. So it's not just about the numbers and have we got a good track record of profit. It's, are those intangible things, those less, you might say, less readily visible things, do they stack up as well? Anyway, that's enough of the negatives. On a successful sale, we can learn from these really positive features now, key features that the buyers look for. And what made this company really attractive in this successful sale situation was a strong track record of year-on-year growth. So not just a sustainable profit, but actually a good track record of growth, both in turnover and profit. And then, interestingly, a strong future forecast. They're interested in not just the historical side of it, but also how robust was the future forecast. Also, the company had good systems, IT and procedures. That was all in place. And that was very, very important to the buyer. They had strong branding and the IP was protected. And they had good control of their supply chain. So they were all features that made it really, really attractive and valuable to the buyer. The main challenges and hurdles they had to overcome in the buying process was making sure they had signed contracts in place with both suppliers and customers. So it's not good enough to say, you know, I've got exclusive rights to sell this product in the UK. You've got to have that exclusivity agreement in place to back up what you're saying. Because if you don't present it at an early stage, it will only come up in due diligence later on. So very, very important. Also, the other learn from it was be realistic with your stock figure. Family businesses do tend to hoard stock, and the buyer will only pay for good stock. So again, be realistic at an early stage on that one. And make sure you're up to speed on compliance, health and safety, and insurance. You might say again, why does the buyer need to know all about my insurance policy? Surely they'll have their own when it comes to it. Well, yes, most likely they will, but they don't want to pick up a business that's got, you know, some hidden liabilities from the past. So they want to make sure that all your compliance is in place now and has been in place for the last 3 to 5 years to give them peace of mind. So some health warnings too in the process. Glad that's not my blood pressure, by the way, but yeah, no, some health warnings in the actual sale process is beware of people, you know, persons posing as buyers, fishing for your good ideas and then walking away. It does happen. So you might say, don't just take it at face value that this company is interested in buying my company. You might just have to be really careful to make sure they are genuine buyers. And you say, well, you know, I'll get them to sign a non-disclosure agreement. Well, that's not really good enough if they're a competitor or an agent on behalf of a competitor, or maybe an overseas supplier wanting to actually start up in the UK. just be really careful how much you tell them at an early stage before you know, obviously you wouldn't want to divulge information to someone like that. So our advice would be, and from experience and from, you know, from experience in these things, is at least for the initial meeting, meet on neutral ground. So set up a meeting and, you know, hire a room somewhere, good quality venue, meet on neutral ground, minimize the risk of a prospect or a competitor finding out too much early on in the process. Gerry, back to you. Hopefully that's useful.
Thanks, Joe. Some really interesting real life stuff there that I'm sure we can all take away. So the key takeaways from today's session. Firstly, I think we've probably made this point pretty well already. Start now to prepare for sale. Secondly, build your business to run without you. These are all things we've heard before, but it bears repeating again. Thirdly, think about having a properly structured incentive plan for your key employees. They're going to be important to getting your business to where it needs to be for sale. Make sure they're on board and invested in the process. Fourthly, review your business structure through the lens of sale. Is there anything that needs changing or improving, adapting now so that you're ready for that? And finally, have a business value assessment and roadmap. And we've wanted to say that we've really enjoyed this series. Actually, we've learned a lot ourselves in the process, and we've been thinking about what we can do to help you to prepare your business for sale. Obviously, we can help you with employee incentive plans and structuring for sale from a tax perspective and from a saleability perspective. But in addition to this, what we wanted to do was suggest a business value assessment and roadmap, which is essentially a full, robust benchmark business valuation, including consideration of those 15 key drivers of value that we talked about and how you score against these. And that would include a call with one of our consultants and a documented roadmap so that you've got some real takeaways for, firstly, what's your business worth now, and secondly, how do we take it to the next level. So there will be a link. I think there's a link on the chat, and there'll be a link coming through after the event as well. So if any of those things are of interest, feel free to let us know. Also, before we move on to the Q&As, just wanted to touch on our next event, which will be held on Thursday, the 18th of August. It's a very topical subject at the moment, with inflation driving property prices up, and many are finding that having been used to their houses and their estates being comfortably within the inheritance tax free zone, they're suddenly moving into that space where they're having to pay inheritance tax just on their house, and that's no longer, unfortunately, as uncommon as it used to be. So the event will cover the impacts of inflation on your taxable estate and what can be done about this, including a number of key points around business assets, planning with the use of trusts and other tax planning tools as well. And also we'll be having a solicitor, a respected guest speaker joining us, who'll be able to advise on how to ensure your estate, essentially ensure your estate ends up in the right place, the pitfalls and the critical importance of having a valid and up-to-date will. So this really is a must-attend event, and we really look forward to seeing you. So moving on to the Q&As, I think we've had a few questions come through. Firstly, the first question is around knowing how much cash a business should hold for a maximum enterprise value based on a certain EBITDA per annum. And I guess the answer to this is that, strictly speaking, cash in itself doesn't affect enterprise value, because typically you'd either extract cash prior to a sale, or the buyer would actually pay you extra for that, pound for pound, as part of the cash and debt adjustment that we talked about earlier. So I don't think there's any right or wrong amount of cash balance to hold other than what's normally needed for trading. It doesn't make any difference to your business value in the end. I think the next question that we've got here is to what extent the sector that you're in affects enterprise value. Joe, I don't know if you've got some thoughts on that one.
Yeah, so I think the question is, different sectors and different trades and so on. What can you apply the same multiple to all of those, or is there a big variance? I think the answer is it does vary considerably, and that's why you need expert help on it. You need to have a valuation. So people, some people, experienced businessmen might say, I always use a multiple of X. They might have a sort of theory that they always use, if you like. Well, that isn't really good enough when it comes to valuing your business. What you need is someone who's got access to the relevant industry data. So what you'll find is a valuer will have access to that. He'll have access to the businesses that have sold recently and over the last few years in the different industry sectors. And basically, that's very, very important. So what we're suggesting is you get like a benchmark now, you get a valuation done, which we're happy to help with that. And we've got access to that data that's not readily available, haven't we, Jerry? So that's what I would recommend, is make sure you're getting relevant value, not just a sort of rule of thumb value, if that makes sense.
Yeah, absolutely. Yeah. No, I don't think there's any substitute for that. I think that's helpful. We've got another question here about, I think you spoke, Joe, about the dangers of people fishing for business information by posing as a buyer. Is there any risk involved in us approaching competitors as a potential buyer? So I think, in other words, the other way around. I don't know if you've got any comments or thoughts on that.
No, it's a good question. I guess the thing to be aware of there, if you're going out looking for businesses to buy at this stage, a couple of things around that is, one is it's so easy in a face-to-face meeting to say more than you intended. So whilst the seller is happily kind of telling you about their business, it'd be very easy to slip in too much about your own business. So I think my only warning there would be, just be careful how much you say. Maybe agree beforehand, if 2 or 3 of you are going to see a business that's maybe a competitor that you're thinking of buying. Agree beforehand what you're going to say and what you're not going to say. The level of information that you say about your own business. You might want to do a presentation about your growth plans, for example. That might be a good thing to do, mightn't it, Jerry? Don't you think? Just a sort of few slides. This is how fast we're growing. This is what we're planning to do. Like that other company we spoke of, we're going to grow 1/3 by organic growth. We're going to grow, 2/3 by acquisition. For example, you might want to present the big picture stuff, but be careful you don't slip in anything that's actually critical information that would give them a handle, you might say. Would you have anything to add to that?
Yeah, no, I think that's good. There's always in these things, there's always a balance, isn't there? And it's about, sometimes even as a buyer, you have to be prepared to sell yourself, don't you? Sometimes, and being able to do that by talking about your growth plans and so on is a useful thing to be able to do, but without divulging critical information, critical kind of business critical info. So I think the next question that we had here was how much effect business systems and handbooks have on enterprise value. Quite a specific sort of point, but I don't know if you had any particular comments on that, Joe.
Yeah, good question. I mean, obviously we talked about having really good business systems and handbooks and so on in place, and that is very, very important. But bear in mind, we said there's 15 points that affect the value of your multiple. Obviously, you've got your track record of profit, your EBITDA year on year for the last 3 to 5 years. That's got to stack up. But this is more the points that affect the multiple, isn't it, Jerry, that we're talking about here? And I would say business systems and handbooks is 1 out of 15. If that puts it in context, it's very, very important, but it's 1 out of 15 important points. So it has, I think in summary, it has some impact, but it's not the whole story. Is that, I think that's fair?
I think that's right, yeah. And you know, you can't necessarily be too sort of scientific about these things, can you? It's all just factors that if you get them right, they can help. If you haven't got them right, it can make things difficult in conversations with buyers. So all we're really trying to do is impact that. And I think there's a question just come through about those 15 points. And I think that's really, you know, if that was something that was of interest to you, that's what we'd be looking at in a business value assessment is what those 15 points look like for your business and how to improve on them. One further question that we've got here is in relation to, again, reasonably specific, but about EBITDA times multiple valuations versus what we call discounted cash flow, which is an alternative method of valuing businesses, perhaps a slightly more theoretical approach to valuing businesses, which I understand is used in other countries perhaps more than it is in the UK. And I think the answer to the question is that in the UK, it is predominantly EBITDA times a multiple. We don't really see DCF, discounted cash flow, being used in practice. That's how all the big deals are normally done. That's how they're measured. That's how they're reported on. So that's the important thing to focus on, really, I think, as far as business value is concerned. Good. So we've got some questions coming in here. We work in a business with a reasonable amount of debtor risk. Lots of small customers who aren't very creditworthy. If the debtors are well managed, is this still likely to drag the value down? I think that's an interesting question, Joe, isn't it? I don't know if you want to kick off on that one.
Yeah, so we're looking at our own business having debtor risk there. I mean, the fact that there's lots of smaller customers is a positive, isn't it? That's, by definition, that's less minimizing the risk, isn't it, of bad debts. The fact that the customers are not very creditworthy is obviously a negative. So I think that's the point to work on, is making sure that we are selling our goods to creditworthy customers, improving on that. So I think the question is, if that's well managed, is that likely to drag the business value down? Well, I guess that's about the track record, isn't it? Again, if your track record is that you're not incurring much bad debt, the buyer doesn't need to know that your customers are, in some cases, a bit shaky. But it just brings to mind another case study, actually, Jerry, if it's all right, just to touch on it. We had to do with a business that was purchased, and this shows the really important need of good due diligence. The business that was bought actually had some really bad customers, and they were not paying. So the first thing that the new owner had to do was address that. And how did he address it? They addressed it by putting some of those businesses on stock, to try and of course the sales plummeted, basically, because a lot of the customers were bad payers. The first thing to address that debtor issue was to bring in some credit control measures, which actually impacted sales. So that would be a warning, wouldn't it, Jerry, for anyone looking to buy a business? Make sure you do your due diligence ahead of time. It's too late after you've actually paid your money over and find that you bought a lot of duff customers, do you think?
Exactly. I think it's an important point because you can have all the agreements in the world, if you like, and we're certainly not minimizing the importance of having robust agreements when you come to buy or sell a business. But at the end of the day, they're only as good as the the ability of the other party to meet those demands, and if something's an agreement and that the other party has either disappeared off or gone bankrupt or something, then there's not necessarily an awful lot you can do about it. So you got to be quite careful making sure you don't let go of your money too soon. Another question coming here about where we find completed deal information for companies sold in our sector. So the equivalent of Zoopla for properties, for example, but for businesses, which is an interesting question. I think this is not information that is as readily available. It's quite hard information to get for businesses, whereas properties is a relatively straightforward thing. You know, anyone can look online and find out just about any property, what it sold for over the last 10 years or whatever. That sort of information just isn't quite so readily available for businesses. It's more complicated to extract, and therefore the information that is there is extracted by platforms that are expensive to access, and so it's not something you can just look up online for free, I think, is the answer to that. I don't know if that makes sense, Joe, if you've got anything to add to that.
Yeah, I can confirm the expense part, certainly. Yeah. There's just another question popped in that I wanted to just touch on, if that's all right, about the buyer. Will the buyer want assets purchased by cash or HP, credits, loans? I'm not totally sure of the context of the question, but it is an interesting point that, and it's a subject in itself. Do we buy assets with cash, or do we buy them, you know, on HP, credit, or loans? It's an interesting point that we could almost have a separate session on this, I think, because there is an argument that says vehicles and things like that are best on contract hire because they're not part of your asset base and therefore they're not destroying the value of your company, for example. But there's also an argument that says if you were buying a hire business, for example, with a hire fleet, you know, would you want to take over, you know, hire purchase on those pieces of equipment or not? I mean, there might be a 10-20% interest for all you know, so you'd be very, very cautious about that. So I'm not sure if I've got the answer in a one-liner, really, Jerry, on that one. I think it's a bit of a knotty one. I think you'd have to work it through with your financial advisor and your accountant as to actually, we're thinking of selling in 3 years' time. What should we do for the next 3 years in terms of finance, do you think?
Yeah, I think that's good. And as well, thinking about it from the point of return on investment, you know, if you're thinking in terms of growing your business as quickly as possible, if cash is a constraint in that growth, then you may well be better off financing some of these assets and using the cash to grow your business. And obviously a bigger business that's grown faster is more valuable. That's probably likely to more than offset any negatives on your asset finance type. But I think you're right, Joe, that there's not necessarily a straightforward answer to the question. Another question here about what the highest EBITDA multiple is that we're aware of for a business that's sold in a typical market that we work in. It's a good question and an interesting one. I mean, I think the answer to it is that when you start looking at it, there's an enormous variation in multiples paid and potentially all sorts of factors behind the scenes that you're not necessarily aware of. A business might not be very profitable, but it might have something that a business really, really wants, a buyer really, really wants, some IP or something like that. And, you know, multiples of 20 or 30 times EBITDA as outliers are not that uncommon, amazingly, in those sort of circumstances. But I guess in the sort of normal range, you know, 10 would be very strong, but you could even get more potentially. And it does very much depend on your business, what other businesses are sold for, and the particular circumstances surrounding the particular deal. So that's why I think really you can't necessarily just kind of use a rule of thumb multiple to value everything. It is very much dependent on the business and what the industry sector is doing. I don't know if you had anything to add to that, Joe.
No, I think that covers it. I think generally speaking, businesses sell between a multiple of 3 and 15, and that's a huge range in itself. And then, like you say, there's outliers. Some might be less than that, some might be a lot more. So I think the point is to get the research done in your industry and see where you fit, get the assessment done as your particular business, and then work on points that are going to increase it, isn't it? Just time for one more question, Jerry. There's just another one come in there about brands. I wonder if you could answer that. Clearly it adds value, but also it's a tax opportunity, isn't it? Do you want to just round off by answering that question for us?
Yeah. So I think the answer to the question is yes, it could increase your value. I think if you are...
Just read out the question. Sorry, I didn't do that.
Sorry, Joe. Yeah. So the question is, we don't have many brands, but technically could quite easily create some and put them on a lot of unbranded product. Would this be recommended, or is it not that simple to add value? And I think the answer to that is, you know, if you are selling unbranded products, think about ways to brand and own your own products. And obviously, I don't know what industry you're working in, what products you're selling. It's not necessarily always workable, but as a general thing, you're much better off if you can build your own brand rather than building somebody else's, and that creates value. And even just a simple the simple act of adding a brand name and then registering that can, I think, in itself add value, because all of a sudden you're creating some value there that a buyer will potentially pay more for. There's also some interesting tax opportunities around that as well, in the area of profit extraction. That's probably a subject for another day, but that's certainly worth looking at, I think. Good. Well, I think that probably brings us to the close of this session. Appreciate everyone's input and interaction, all the questions that have come through. I hope there's been some value and some takeaways. And please look out for the follow-on session with the recording. Thank you for attending, and hope you have a very good afternoon.